everybody. Welcome to today's episode of the Daily Dose. Today is Thursday, December 15th. I just want to start out by saying that I really appreciate the surge in listeners that I've been getting to the podcast recently. I really appreciate everyone that's been listening, and I hope that I've been able to provide good content to you guys. I really do enjoy making these daily episodes, just quick little episodes. Kind of get the snippet from the market that day or any big news. And I'm glad that other people are finding value in it as well. So if you like it, make sure to follow. You can also subscribe on YouTube and just share it with other people so that we can continue to grow the show. So with that, I will get into it today. So we saw a ton of selling today as the market is kind of coming to grips with the reality of the situation at hand following the FOMC meeting yesterday, where the Federal Reserve remained hawkish despite only raising interest rates by 50 basis points this meeting instead of by 75 in the previous session or in the previous meetings. So if you've been following the show, you'll know that I've been extremely bearish since we came up to the trend line here. And if you're listening on the podcast, I guess just go to the YouTube to see the chart. But yeah, we came up to the trend line, we touched it, we bounced off, and then we actually breached above it back on Tuesday. Intraday, we didn't end up closing above it, but we actually double topped here around 4,100. and we've been selling pretty aggressively ever since. Yesterday was a volatile situation as far as being green and then red and then back green and then red again. But I've kind of been saying that I was expecting to sell off heavily, one, after the FOMC meeting, because we had another rally into the meeting, and I mean, there's no fundamental difference in what's going on in the previous meetings throughout the year. And they've all gone the same, and that's that we get that huge surge right before the meeting, kind of into the beginning of the meeting, and then throughout the end of the meeting / while Powell's taking questions, and then in the next couple days we see that hard selling. And today we saw the first day of that hard selling following the FOMC meeting. And if you're asking yourself, why is the market still crashing? The Fed is slowing down the rate of their interest hikes. Why isn't the market going up? Isn't that a good sign? And yeah, well, it's not as restrictive as it would have been with another 75 basis point rate hike. The reality is still the same, is that there are extremely restrictive conditions right now in the economy set in place by the Federal Reserve. And they continued to preach yesterday that they want to create an environment that is extremely restricting for a long period of time. So they're not even to their peak federal funds rate yet, which keeps going up month after month. It was 4.6%, now it's 5.1%. And they said that they're going to keep it there for some time. And according to Jerome Powell yesterday, they might not cut rates at all in 2023. Now, I think that they're probably going to have to, but as far as the rhetoric we're getting from them right now, they're trying to be as extremely hawkish and restrictive as possible. And the reasoning behind that is obviously because they want to snuff out inflation, that the job isn't done yet. There's still some components to the core CPI that we're actually increasing, such as food and shelter. And they also still see a really strong job market, which from their point of view, they need to weaken to get inflation under control, to restore price stability. As Powell said many times yesterday, price stability is really the key to true economic growth, according to Jerome Powell, and that's what he's trying to restore as quickly as possible. And he also mentioned again, as he has throughout the series of these FOMC meetings this year, that he does not want to recreate the mistakes of the Fed and Fed Chair Volcker from the 70s when they had their episode of inflation. And he talked about how they actually reduced rates too soon and that they're not going to make the same mistake. So a lot of the indicators that the policy might be too restrictive are lagging indicators, and so he's able to point to the numbers that we're getting right now and say, hey, from our point of view, the job market's still strong. Inflation hasn't come down as much as we would like it, and everything's fine and good. When in reality, we might get those economic breaks and a deep recession in the next year when this restrictive policy kind of settles into the economy. So I think that's going to be really interesting as far as next year goes. If we'll see something kind of break, if we'll see a deep recession, I think that's still possible for sure. I think a quote unquote soft landing is also still possible, but I don't think it is possible if they follow through with what they've been saying. I think that they would have to pivot next year for that to happen. And I think that they still could do that and get inflation under control. I think that inflation is going to fall a lot quicker than people think, and that we might even have some deflation. We might have inflation under 0% in 2023 or 2024, depending on how things play out. So that's kind of the fallout from yesterday. As far as the stock market goes, yeah, I mean, we were expecting this on the channel. We were expecting this selling. We are sitting on kind of like a support rather right now. So maybe we get a little bit of buying tomorrow morning or throughout the day, or some sort of little recovery. But I mean, honestly, after these FOMC meetings, we've seen aggressive selling. So here, for instance, let's take this example. Selling through this same exact zone, actually. So they had selling, hit the bottom, recovered, came back below, came back to the top. It acted as a resistance here and then sold off. So maybe we'll even see a similar situation. So maybe tomorrow on Friday we get that little recovery where we're kind of just still sitting above the support. And then maybe Monday, Tuesday we break below, come back, and then Wednesday, Thursday, Friday next week we sell off to here around the 37.50. So that's kind of what I'm looking at on the stock market at this point. Again, if you're listening to the podcast and you kind of want to see the numbers that I'm saying, head on over to the YouTube and you can see the chart that I'm looking at right now. And you can see all my levels, the trend line, all that good stuff. And be sure to subscribe while you're there. But if not, it's okay. You can get all the information that you need from the podcast anyways. So yeah, that's what I'm looking at on the stock market. But let's take a look at Bitcoin, because I like to take a look at Bitcoin, and we can talk about that a little bit. Bitcoin also sold off today. Again, we talked about that as a real possibility. So now here's where we're at, in my opinion, with Bitcoin. So we're back below the 17.5. So this clearly was a testing of this level, so like the bottom of this range that we were in for a long time, about 5 months actually. So we came up, touched it, rejected it really hard, and then the stock market sold off today, and so Bitcoin continued downwards as well. So I mean, that's exactly what we've been saying on the channel that was going to happen. So Bitcoin kind of looks bearish now too. Again, if you've been following this channel for a while, I've been talking about the 12,000 to 10,000 window as the next kind of main level that I'd expect to see from Bitcoin. And me personally, I'd be a buyer at that level. I don't care if it goes a little bit lower than 10,000. I'll ride it out because I think that that's a good entry point. So that's what I'm looking at on Bitcoin. I don't really take the FTX collapse to heart when it comes to Bitcoin. I think it's a wake-up call for all the other cryptos that I think 99% of them are completely useless, and they will crash and burn eventually. I think the only crypto, if you even want to call it a crypto with a real use case, would be Bitcoin. As far as like financial freedom and independence from a government or any sort of corporation or entity. The ability to take self-custody is just really, it's game-changing as far as the financial environment goes. So that's why I like Bitcoin. It's really the only true decentralized, uncensorable type of money, type of energy, transfer of wealth. I mean, uh, yeah, I think it's a great tool that hopefully is able to be used for good and that doesn't get handicapped by incompetent governments or governments that recognize the ability and recognize that this takes away some of their leverage when it comes to the economy. So obviously there are risks. I'm not saying it's foolproof or that it's just gonna go straight up after it hits whatever level it hits. It's a volatile asset. It's a volatile space. It's still really new. There's a lot of development going on, but I think people that do their own research on it, like real research, not just listening to whatever YouTube ad comes up or whatever you see on your Twitter feed, I think if you do some real research on it, you might be surprised by what you find. So, yeah, I like to talk about Bitcoin, so I'll stop blabbering on about that now. But we can go back to the S&P 500 before we close because that's really the main market that we look at here as kind of the barometer for um, the markets in general. I won't say the economy because the stock market is not the economy. But yeah, so that's what we're looking at. We saw some selling. We expected that. And now we're kind of headed lower, trending lower after touching this trend line. So the trend line held again. It kind of got that double top at 4,100 above the trend line, but none of these candles actually closed above our trend line. So we'll continue to look to that as the main indicator. That's why I took the 200-day moving average off this chart because we were looking at that pretty heavily and it actually got closed above a couple times. So I'm going to use the main indicator for this bear market. I think that the 200-day moving average is definitely a great tool, but as far as this bear market goes, it's clear that it's going to respect this trend line as its main lead. So yeah, that's where I'll leave it today. I'll won't ramble any further. Again, if you enjoy this type of content, be sure to follow the podcast so that you can listen when they come out every day that the market is open. Be sure to subscribe on YouTube as well. It really helped the channel out. I appreciate everyone that's been listening to these, who's been watching these. So thank you, and I will see you tomorrow.